Are you sure?
Here's the 30-second lesson on what legends know. Never ask a bride why she's getting married. Don't wear a skirt on a windy day. Deodorant is not a shower. Don't sniff chili flakes. And don't forget, saving is not investing. Legends don't just save, they invest in mutual funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this episode of Macrosutra. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint. And this time we're going to be talking about what the government's first advance estimates for this current financial year, FY 23-24, says about the economy, how it's done in this year. And to discuss this, we have with us, as always, Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for joining us.
Sharad.
So now, Radhika, as I mentioned, it's the first advance estimates that have come. So as a brief recap, we've talked about it before, but could you tell us about the various estimates that come out of GDP and when we can expect the final figure?
So for every GDP number for any year that comes, there are 6 estimates. Okay, so there is this first advance estimate, then there is second advance estimate, then we have a provisional estimate, and then we have 3 revised estimates: first revised, second revised, and third revised estimate. So what we got on the 5th of January was the first advance estimate for the current financial year, which we know is still not over. So it's not based on the full 12 months data. It is based on 7 to 8 months data, and for the rest of the month some extrapolation or some projection is done based on the past year's data.
I see.
So it's called in NAS terms, in the terminology of National Account Statistics, it is called the benchmark method, where they look at certain benchmarks and they look at certain indicators. For example, for the manufacturing sector, they look at the IIP manufacturing, they look at the performance of listed companies, and they look at what has been the growth in the first half of the year, which we already know because in September, when the GDP number for the second quarter came, we also have an estimate for the first half.
For the first 6 months.
Yes. So for the first 6 months we have, and then we have the data for the previous financial year. So based on some assumptions, the NAS makes extrapolation for the second half, and then we get the full number for the first advance estimate. So it is bound to get revised because on 28th of February we will have the second advance estimate, and then on 31st of May we will have the provisional estimate. Now provisional estimates will primarily cover the full data. Again,
for the full year.
For the full 12 months data. But there would be some limitation because not all companies release their data by, say, April, May. So again, there would be some assumption. But again, in terms of completeness of data, we can definitely say that provisional estimates have a better data coverage as compared to first advance estimates.
Or even the second.
Or even the second, yes. We don't see much difference between first and second advance estimate. The reason why first advance estimates are released is because they are useful for the budgetary projection.
I was going to say.
Yeah. So that is the main reason, because we need to have some estimate of growth of this financial year, and on top of that we will have some assumptions for the nominal GDP growth for FY25, because that serves as our denominator for various fiscal targets like fiscal deficit to GDP ratio, revenue deficit to GDP ratio. So all these numbers require having some understanding or assessment of the current year's GDP. On that we make the Ministry of Finance makes assumption for the growth for the next year. For example, there are this understanding is given that for the next financial year the nominal GDP growth is assumed to be 10.5%. So that is 10.5% over the current advance estimate.
The first advance estimate
we've got. So that is the significance of these first advance estimates, and therefore they require discussion about which what sector, like we'll be talking about which sectors are driving growth, which sectors are still showing weakness. So it requires that discussion.
Right. So in short, it's even though the data that we have is only for a few months of the year, about 7 to 8 months, and the rest is extrapolation, the first advance estimates are still actually quite important because they determine a lot of the targets that are set in the upcoming budget, which is on Feb 1st. So let's get on with it then. So what does the first advance estimate say for the full year for overall GDP growth? We'll get to the sector wise after that.
So for the overall GDP, it projects a growth of 7.3%.
Right.
That is, for this financial year, GDP is expected to be 7.3%.
That's
which
quite
is
strong.
Very strong, which is even better than the previous financial year, because in the previous year, as per the provisional estimates, the growth was 7.2%. And even this growth surpasses all the projections that have been made by various agencies, be it IMF, World Bank, or even the RBI.
Even RBI, right.
Because the Reserve Bank of India had initially projected 6.5%. And then after the second quarter data came out, they revised their projection by 50 basis points,
Right.
made it 7%. But the actual growth as per the first advance estimate is 7.3%. So that is on the expenditure side, the GDP growth is 7.3%. If we look at the gross value added, which is capturing the activity side of the economy,
Right.
the agriculture, industry, and services, there the growth is 6.9%. So both are very strong numbers given the global headwinds, given the other challenges, given the agri slowdown. These are strong numbers on a relative basis.
But then this would also suggest that in the second half of the year, we're set to accelerate.
Yes, we are set to accelerate because in the sense that, for the first half, the growth rate came to be 7.7, and now for the full financial year it is 7.3. So there is a bit of a slowdown, but it's
not accelerate. Right?
Yeah, but it needs to be seen where exactly the slowdown is happening and where exactly they have projected a higher growth, and whether those things are on the optimistic side or whether they are realistic. So those are the things that need to be discussed. But yes, definitely it shows a slowing down in the second half, but not to the extent that was earlier estimated, because if it was thought that the growth rate would be 6.5%, then we would have thought that the extent of slowdown in the second half of the financial year would have been much deeper.
Yeah. So then let's get into the sector wise. Which are the sectors that these first advance estimates say will be driving growth?
Yeah, so let's first start from the activity side.
Right.
So there we see that it's the industry that is driving growth, and within industry also it is the manufacturing sector.
That's very good news.
Yes, which has picked up. The growth is expected to be 6.5%, up from 1.3% in the previous financial year. So it's a big jump from the previous financial year.
And some of it is the base effect?
Some of it is base effect, but more importantly, what is important is that it's mainly driven by boost to profitability. Okay,
Right.
So that is important that in 2022, we saw commodity prices rising, and that impacted the input cost pressures, and that impacted the profitability of firms, and hence the gross value addition of the manufacturing sector.
Right.
But this time around, from the September 2022 highs, we have seen a moderation. If we look at oil prices, we look at food prices, we look at metal prices, we look at an indicator called the Bloomberg Commodity Price Index, which the RBI looks at very regularly. We see that all these prices all these costs have shown a decline. So that is reflected in giving a jump to profitability.
Right.
And therefore, the GVA of manufacturing sector has increased, not due to increase in output or increase in sales.
I was going to ask. So it's not actually as if activity has increased and that they're selling more. It's just that their costs have come down.
Exactly. So that is a very important point to note that, what is the source of this rebound in the GVA of manufacturing sector that we are seeing? Is it being driven by more demand, or is it being driven by cost rationalization? So it turns out that it's mostly being driven by cost rationalization, and which has given a boost to profitability, because we actually see a very interesting correlation between the output of firm, the growth in output and the household consumption, which is the private final consumption expenditure.
Okay.
And because consumption expenditure has not picked up, the sales growth are also quite muted.
Right.
So it's not driven too much by the output growth, but it's driven more by the cost reduction. So that is one important point.
Right. So now, although the manufacturing sector will be adding to the growth numbers,
right,
we can't say that this is actually like it's becoming stronger or that it's helping the economy in a real sense, right?
Yeah. So in terms of GVA, because gross, it is value addition, but it's not output growth.
It's not output.
There is a conceptual difference between output growth and value addition.
Yes.
So even though your output is constant, but because your cost is going down, your value addition has picked up. But again, interestingly, another point is that because we have the first half data and then we have the full year data,
right,
we can actually impute what's going to happen in the second half.
Right.
And what we see is that there is a steep decline in the manufacturing sector performance in the second half. So the 6.5% growth that we are seeing in the overall financial year is primarily driven by the first half, because in the first half we are seeing a growth of 9.3%,
right,
which reduces to 3.9% in the second half.
Oops.
So in the sense, what we are getting is that now again you see, all these costs have started to inch up. We are seeing the disruption in the Red Sea. We are seeing some pickup in WPI also. So international commodity prices have started to pick up. So the support that was given to the GVA due to reduction in costs may not be sustained in the second half. And therefore, we are not seeing the same kind of growth overall that we saw in the first half.
Right.
In the first half, we saw more than 9%. Overall, we are seeing 6.5%. And this is primarily because in the second half, there is a slowdown. And that is also reflected if you look at some of the high frequency indicators like PMI manufacturing.
Right.
We saw PMI manufacturing for December was the lowest in 18 months.
Yes.
And in October, December also quarter, it was one of the low numbers. So there is some sign of slack in PMI manufacturing and it needs to be seen. So high frequency numbers actually corroborate the imputed growth of manufacturing in the second half, that it is tapering off from the high that we saw in the first half.
Right. And so, okay, so manufacturing, now we know what's happening. Agriculture also largely we know, the monsoon has been erratic and so agriculture growth won't be that strong. But services, what's happening there?
So before services also, let's see, construction is being doing. Construction has picked up, and construction is one sector which is showing more than 10% growth in the first half as well as in the second half,
right,
which is expected given firstly the push to capex by government. It's also reflected in the buoyant performance of the real estate sector. We look at the real estate performance, if we look at the loans for housing, all these are showing stellar performance, and also we see physical savings of households picking up.
Right, they're putting it in physical assets.
Physical assets. So all that bodes well for the construction sector. And also if we look at the high frequency indicators like steel consumption, cement production, all these are showing a sustained growth. So from the activity side, it's the manufacturing and construction sector which are the prime drivers of growth.
Right.
Coming to services, I would not say it is a moderation, but it's a normalization, because we saw pent-up growth. During COVID, there was a deep impact.
Nothing. Yes.
And then we saw an increase in services growth, but now it's showing a normalization.
Okay.
And that is reflected if you look at, even the bank credit growth that we spoke about, that from 17% growth, now it's going to come down because of the lagged effect of interest rates, because of the tight liquidity condition. And, the main, within services, the main sector is the trade, hotel, transport, communication.
Right.
And within that also, trade is the most important sector. And we are seeing the headwinds to trade due to global slowdown, due to these fresh disruptions that we are seeing. So it is understandable that we won't see that high growth that we saw in the previous quarter. But even now, the growth is quite decent. It is moderated, but it is more towards normalization rather than substantial slackening or weakening of growth. So for that, we still need to wait for a few more quarters to see what happens to services growth. As of now, I think the assessment should be that it is more moving towards normalization.
To normalize. So it's not as if it's subdued or anything.
Yes.
It's moving towards normal level.
Normal level.
Okay. And now looking on the expenditure side,
Correct.
We know that the government is spending lots on building capex. So government expenditure has been quite a driver of growth for the economy.
Absolutely.
But are there other sectors of expenditure, like say consumption, is that picking up in any way to help out?
So it's, from the expenditure side, it is investment driven growth. And that,
Right.
as you rightly pointed out, investment has is estimated to grow at 10.3% year on year in this financial year. And as a share of GDP, it has risen to new highs.
Right.
In terms of both nominal GDP as well as real GDP. In terms of real GDP, it has reached the level of 34.9% investment, which is
Wow.
gross fixed capital formation as a share of real GDP. So these are numbers that we used to see in pre-global financial crisis period
Right.
in the early 2000s. So we are seeing that kind of situation. But as you said, it's primarily driven by government capex. Which
And
we
in
have
that
seen.
point, it might have been private sector that was doing
It was private sector.
Right.
It was bank credit fueled growth. It was high leveraged growth
Right.
and private sector driven. Exactly. But here it is capex driven. Until now, we do not see a letdown in that. In the first 8 months, we have seen government capex. Government has already spent around 58% of its budgeted capex, and
Right.
it's 31% growth over the first 8 months of the last financial year. So we are seeing, and there are also indication that in the next year also the government would continue to carry its momentum on capex. There are these indications that capex would rise to rupees 12 trillion from 10 trillion budgeted,
which was already a record number.
which was already a record number. So it is mainly driven by investment. On consumption, it is uneven because, again, if we look at, we can't make out from the private final consumption expenditure, but if we break down and look at the series of high frequency indicators that capture consumption, we see that the urban indicators are doing well, but it's the rural indicators of consumption,
Right.
FMCG volumes, those have not picked up at a encouraging pace, and that is what is reflected in the private final consumption expenditure, which is 4.4%. Lowest for this base year series. So consumption expenditure is a cause of concern, mainly because of poor agricultural performance and high food inflation. So those are two reasons for the subdued rural consumption, which is reflected in a number of indicators, and that is what we see in the consumption side. So yes, there is a kind of skewed consumption pattern that is emerging, that's more clearly evident if we look at the high frequency numbers.
Right. And now we talked about in the beginning how these first advance estimates has a bearing on the government's fiscal maths.
Right.
So let's get into that a little more
Yes.
because these targets like fiscal deficit and all of that are important.
Yes.
And so how does it affect it and what is the likely impact?
Right. So during the time of the budget, the government had pegged nominal GDP growth at 10.5% for the current financial year. But what we see from the first advance estimates is that the nominal GDP growth for the current year is 8.9%. So in absolute term, there is a reduction of almost 5 trillion rupees in terms of GDP.
Right.
So when you have a lower base, then if you have to maintain the same fiscal deficit in absolute level, this would imply some slippage in your fiscal deficit to GDP ratio, because if your denominator goes down and you keep the fiscal deficit as what was, if you are able to achieve the fiscal deficit in absolute level terms, which was somewhere around rupees 17.87 trillion.
Then of course it will be a larger percentage.
Yes, larger percentage, which is expected to be not too much, but 10 basis point, 6%.
So it'll be 6%.
It will be 6%. So to bring it down to 5.9%, which seems that the government is very serious towards achieving its 5.9% fiscal deficit target, and it's going to have a more aggressive target next year, then it will have to reduce its fiscal deficit by 40,000 crore, roughly 40,000 crore.
So either increase revenue or cut expenditure.
Yes. And on revenues front, it is doing well. There was some slowdown around October, but we are seeing again revenues are buoyant. It's only the disinvestment receipts which are disappointingly low, but then they would be covered by dividends from the RBI, which are quite high, dividends from PSU banks, which are doing well. So on the revenue front, there's not much of a problem. We will have to see what happens to expenditure. We will have to see what happens to revenue expenditure, whether the government is able to curtail it, or in the second supplementary demand for grants, we see more shift towards revenue expenditure,
more subsidies,
which could overshoot the revenue, lead to overshooting of the revenue expenditure target, and hence the fiscal deficit. But even then, the extent of deviation would not be too much. Even it will be 10 basis points. It will not be too much because of the buoyancy in revenues. Even with a 8.9% nominal GDP growth, we are seeing that the taxes are doing quite well. The growth in taxes are quite high.
Right. Even
if we look at net tax revenues or gross tax revenues, they are doing quite well. So buoyancy in taxes is definitely there. It is quite encouraging. So even if there is a slippage, it won't be too high. It will be a minor slippage due to the slowdown in the nominal GDP growth. The concern, what we see in the overall advance estimates number, is on account of exports. Because if you look at the exports numbers, what they have projected is 1.7% growth overall.
Right.
But in the first half, exports showed a contraction. So that means that in the second half, the exports will have to grow by 4%.
Which is unlikely.
So that is another area. There is a reversal in one kind of reversal that we saw in manufacturing, where it was rising, and in the second half it is falling. And now another kind of reversal of trend in from first to second half we are seeing in exports, where it is contracting, and then in the second half it is expected to rise at a 4% growth.
Right.
So that is something that needs to be seen. That may be an area which seems to be based on optimistic assumption, because we don't expect exports to grow at 4% in the second half, given the fresh headwinds to exports due to the disruption, and the fact that global growth is expected to slow down further in 2024 from 2023.
Absolutely.
So that is one area. But overall, yes, if you look at the headline numbers, they are quite encouraging.
So that's actually what I was going to end this discussion with, that if you were to say rank the health of the economy on a scale of 0 to 5, where 5 is healthy and 0 is absolutely unhealthy, where would you put us?
So I think it is healthy, because we have the absolute level. If we look at overall growth, it is 7.3%, which is quite healthy. It needs to be seen, and if the capex momentum is maintained, we should see 6.5, what people are projecting for the next financial year, around 6.3, 6.4.
Right.
Definitely it will slow down in FY25.
But that's in line with the world.
That's in line with the world, yes. And also the pace of slowdown would not be too much. So, but what is important is that consumption needs to pick up, because exports is something that is not in our hands, and it's not going to pick up anytime soon, given the slowdown. The UN report came, the World Bank report came. They are all showing a steep slowdown in global growth in calendar year 2024, being driven by US, because now the impact of the interest rate hikes will be visible. UK, EU, all either closer to recession or very weak growth. So export will remain a drag on growth, but consumption needs to pick up. And if we are able to see that, and that will again be determined by inflation. If inflation is controlled, then I think we are fine. So Yes, in terms of number, I think 3.5 to 4 is a good assessment.
That's quite good. So there you go. Radhika rates the economy at 3.5 to 4 out of 5, which is quite good. The data itself is actually quite favorable. The manufacturing sector is rebounding. Growth is strong. Although it seems to be driven more by a reduction in costs rather than an increase in sales, it's still a good, healthy number. Agriculture is not doing that well, but we knew that the rains haven't been great, and we knew that the sector is not going to do that well. Construction is doing very, very well, double-digit growth in the first half and second half, and this is driven mostly by government expenditure, but also the real estate sector seems to be booming. So that's great news. Services is it's moderating, but it's coming to its normal level. So you can't say that it's slowing down or that it's subdued. It's coming to a normal level, which is also good news. Overall, the economy seems to be doing well. Maybe they've overestimated what export growth will be, but we'll have to see what it actually turns out, how much the overestimation is. But overall, the number is good. And on that note, that's all from us. Thank you so much for watching.